Do you realize there's a fairly safe way for you to make, let's call it 50% to 100% or even more on a 1 to 3 year long trade using safe U.S. government Treasury exposure? U.S. government Treasuries are thought of as boring, low return, but very safe investments. But are they always? For months, I've been talking about this being the trade of the decade. I think, personally, as the Fed lowers rates this coming year, these long treasuries are going to be the place to be. So there's a lot of upside potential here for a fairly safe asset class. This is a unique opportunity. You can see how we had a very nice rally when everyone thought there would be 6 or 7 interest rate cuts in 2024. When that story went away, you can see that people ran away from treasuries. I think long-term, this will turn out to be a mistake, that these are really a bargain at these levels. Remember, these carry much less risk than equities, and you've got longest duration treasuries down 20%. So just to get back to zero, these have to go up just to get back to even, probably 25%, let's call it. So that's a heck of a gain for a fairly safe asset class. So look, these long bonds, this purple line, they're not far off of where they were back here. And they're down 21, 22%. So they have to go up more than 25% just to get back to zero. And these are fairly safe haven assets. So that kind of return over however long it takes, whether it's 6 months or a few months or a year, that's a really good return for a safer haven asset. And the fruit is just starting to ripen. Typically, U.S. government treasuries act as a balance to the equity risk in your portfolio. Under normal circumstances, when there's a flight to safety, Treasury long bonds go up very quickly as equities drop, as you can see here, 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 and here. This counterbalance creates a nonlinear effect in the long-term performance of your portfolio, as you can see here. The portfolio has better loss characteristics than any of the components and most of the return of the highest risk component. This is a really, really good trade-off. For months, I've been pounding on the table about long-term treasuries being the bargain of the decade. Well, now is the time for treasuries to move higher over the next 1 to 3 years. You're probably asking, but how can I get 50 to 100% or larger returns from safe treasury bonds? We're currently being presented with an opportunity that might not come around again for many, many years. In this rare instance, exposure to long treasuries through a leveraged ETF like TMF presents the opportunity for very large upside moves with limited exposure to downside risk. Look, this doesn't mean there's no risk, and you should consult with your financial advisor and do your own analysis before investing in this shorter term, let's call it 1 to 3 year opportunity to potentially make outsized returns over a fairly short time frame. Why does this trade present unusual limited downside along with large upside? Well, look, you can see here we're sitting at an inflection point in the interest rate cycle where the Fed is now going to be forced to lower rates to head off a bad recession. How much they lower rates is anyone's guess. But even if they just lower rates to more normal levels, you can see the potential for TMF to move substantially higher in the next coming months or more. Look, this is where TMF closed this past Friday at $59.41, with a 10-year Treasury yield just finally falling just below 4%. Well, if the Fed lowers rates and the 10-year Treasury yield just goes to its normal range of 3%, the price range of TMF is now $76 to $159. That's a 30% to 167% potential gain in a fairly short time frame. Now, if rates fall even further and the 10-year yield drops to, let's call it 2.5%, now the price range of TMF goes from $88 to $180 for a potential return of 48% to 200%. That's 3 times your money. And what about the downside? Well, look, we're currently here where TMF closed at $59.41, as I showed earlier. But what if rates were to go up? Now, there's almost no way in hell the Fed's going to raise rates, but let's say they did. Well, if they raised rates a lot, the price of TMF at its very low was at $37. So that presents a 38% loss from where we are now. But that is extremely unlikely to happen. So this is one of those very rare opportunities with very limited downside and unlimited upside. That's exactly the kind of position you want to put yourself in whenever it presents itself. If you found this video useful, please hit the like, subscribe button, and share this video with your friends and family. And as always, I appreciate it when you leave comments down below. With all that, let's go through the current health of the stock, bond, gold, and crypto markets. Well, you can see here we've had absolutely a disaster of a week. All of the equity indices dropped precipitously starting on Thursday and into Friday when the numbers came out in a way that the markets didn't like. So you can see that the worst drop was ARK Invest, followed by small caps, followed by the NASDAQ, and then the Dow and S&P finished up here on top. But all of them finished negative for the week. What about over the last month? Well, we had a very nice rally, which has, as you can see, fizzled out. But what's interesting is small caps are still on top, followed by the Dow, followed by the S&P, and then the NASDAQ and ARK are down here at the bottom. What about year to date? Well, if we look at year to date, you can see that we still have somewhat of a healthy rally with the NASDAQ just being edged out slightly by the S&P 500. Small caps are up here with the Dow, and then ARK Invest is really far behind. And then if we look at 1 year, very similar picture to what I just showed you. So what are we seeing in the bottom dynamics? Well, this is interesting. We had a confidence level here that was just shooting up very sharply. In fact, you can see it peaked out here just about maybe at 90% or a little bit higher. But what was interesting is while it was up here at 90%, the bottom forming indicator was moving higher and the markets were faltering. But since the markets started to really fall off, the confidence level has dropped. This tells me that any herd behavior is dissipating here, and it's not likely this will continue. Now, what else gives me that feeling? Well, let's take a look at risk versus opportunity. You can see how the S&P has been falling since back here. It tried to rally and then really tanked over the last couple of days. But what's interesting is while the risk acceleration has been increasing, you can see that as the markets fell, the risk acceleration actually started to drop and the opportunity acceleration started to increase. This is a total divergence here. And you can see that the risk level, which is very much of a lagging indicator, has kind of bottomed out here and has started to move higher, and you can see the lag. This is just starting to move higher, whereas this started moving higher way back here. So you can see that there's at least a good month lag in here. And what about the opportunity level? Well, very similar picture. You can see that this peaked out back here and it kind of went sideways to slightly higher, even though the opportunity acceleration started falling off way back here. Well, again, about a month lag in this indicator. And what about equity versus safety? Well, let's jump right into the overlays because this is a really interesting picture. So you can see that small caps IWM are still right up here solidly in first place. You can see that the Dow has pulled back. You can see that cash has moved down. Now, normally I would say that's a good thing, and I still think it's a good thing, and I'll explain why, but you really have to take it in context of what's going on with Treasuries, and we'll talk about that in a minute. Now, what I really like here is that I like the fact that the S&P 500 is now in 10th place, but it's been displaced by the NASDAQ 100. The fact that the NASDAQ 100 is moving up here is very good. And what if we look at the action in safe haven assets? Well, this is what I was talking about with cash. You can see that long bonds, TLT and EDV, not only shot up here, but now they're in a totally healthy relationship. You've got the longest duration treasuries here, 20-year bonds here, intermediates here, and short-term down here, and cash got pushed down. And then what about gold? Well, clearly there's no inflation. And so gold is really falling back here to 7th place. And how does this show up in the buying and selling pressure? Well, it's interesting what's going on here. There's some divergences happening here, which is telling me that equities are likely to go higher sometime next week. Let's take a look at what I'm talking about, and we'll also show this with ARK Invest. So if I put some overlays on here, you can see that the price action of the Dow has dropped, but you can see that the selling pressure has also dropped over that same time frame. That's a divergence. The buying pressure, this solid gray line, has increased over this time frame. That's a divergence with the dropping price. What about the S&P 500? The same thing. Dropping price, dropping selling pressure, increasing buying pressure. Divergence. What about the NASDAQ 100? Dropping price, dropping selling pressure, increasing buying pressure. Again, a divergence. What about small caps? Dropping price, slightly dropping selling pressure, slightly increase in the buying pressure. Again, a divergence. And then ARK Invest, similar picture. Big drop in price, small drop in selling pressure, small increase in buying pressure. And what about sector rankings? Well, if we take a look at sector rankings, these move very slowly. And you can see that last week it was showing we had a very healthy risk appetite here. And this week it's shifted a little tiny bit, but it's showing we still have a fairly healthy risk appetite. We all know that's not the case. So let's jump right into sector rank acceleration, where these react more quickly and give you more of a sense of where things are headed. So what looks good here? Well, not much. You can see that emerging companies, small caps, basically stayed put, so I put a yellow line here. And the Dow basically stayed put, so I put a yellow line here. But there's really nothing else I can point to here that looks healthy. So what doesn't look good? Well, quite a bit. You can see all the red, orange, and yellow going on here. Look, first of all, consumer discretionary dropped a lot. That's very much a red flag. Emerging companies, the next level companies below the NASDAQ 100 in the NASDAQ index, those dropped a lot. Clean energy, which has been driven by the whole push toward AI, dropped an immense amount from all the way up here to all the way down here. What about NASDAQ 100? Dropped way down to here. Semiconductors, way down here, all the way at the bottom. And XLK, which is also tech, way down. You can see cash moved up, not good. Gold actually moved up here, even though it moved down in the equity versus safety rankings. And then I put a red line on consumer staples. I know sometimes I've put a green line on here with it moving up, but in this case, I think there's a flight to safer stocks than to riskier stocks. So this is a red line. And then what about treasuries? Well, it's kind of a mixed picture here, because you could call this a flight to safety. The fact that 20-year, 7 to 10-year, and intermediate treasuries have all moved up higher. You could view that as a red flag, saying, oh, it's a flight to safety. But I think it's just as much, if not more, a run toward opportunity, because interest rates are dropping. That makes an opportunity here for these treasuries to move quite a bit higher. All right, and what about treasuries? Well, if you look at treasuries over the past week, we've just had a spectacular rally here with a very, very healthy risk appetite for treasury risk. And what about over the last month? Well, you can see we had a sell-off and then just a blast higher with the longest duration treasuries right up here at the top. This is exactly what you want to see. Year to date, oh my goodness, this launch has almost put us back to even for year to date since the beginning of the year for the longest duration treasuries, and shorter duration treasuries are already positive. What about over the last year? Well, over the last year, you can see we've already blown through where we were a year ago. And then let's take a look at 5 years, just out of curiosity. Still a very long way to go. And this is the whole thesis of the first part of this video. We're still down 39% on the longest duration treasuries here. So, for almost 40%, you've got to go almost to 100% just to get back to even. That's a lot of upside here. And how does that show up in the buying and selling pressure for treasuries? Well, let's take a look at the same divergent picture that we looked at with equities, and you can see there is no divergence here. We have increasing price for short duration treasuries. You can see that the buying pressure was basically flat, but the selling pressure was tailing off a bit. For intermediate treasuries, you can see increasing price, increasing buying pressure, and decreasing selling pressure. The same for IEF, 7 to 10-year treasuries, increasing price, buying pressure increasing like a rocket ship, and selling pressure falling through the floor. Long bonds, TLT, increasing price, increasing buying pressure, decreasing selling pressure. Again, just falling off of a cliff. And what about that quickly not inverting yield curve? It's still inverted, but boy, not by a whole lot. You can see, and as I've been talking about this all along every week, that rates have to drop at the short end for us to become not inverted. You can see that's exactly what's happened here. We're now only 8 basis points inverted. That's from 110 basis points not that long ago. So that's an amazing bit of progress here. Very encouraging. And how does this show up in the Fed rate monitoring tool? Well, when the Fed meets in 6 weeks, 3 days, 20 hours, and 51 minutes from now, you can see the markets think there's a very high likelihood that the Fed's going to lower rates by not just 0.25%, but by 0.5%. 74% likelihood that that's going to happen. And if we go out to November, now we're talking about a 1% drop in rates. So the markets really think the Fed's going to have to be aggressive here to stave off a recession. And what about gold? Well, gold has been going nowhere to slightly down here. So you can see it doesn't look good. The selling pressure has been falling off recently, but is still above the buying pressure. And what about Bitcoin? Well, Bitcoin really tried to rally here coming off of this bottom, but you can see that it's really fallen off and the selling pressure is increasing at a very rapid rate here. So as you can see, there's a long-term buy and hold opportunity in Treasury long bonds. They're right near the recent lows here. And a shorter-term trading opportunity in the leveraged long bond ETF TMF to potentially make 50% or more over the next 1 to 3 years. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.